Today we're going to have a detailed look about the inflow of international capital that's currently targeting the US market. We're lucky enough to have three esteemed colleagues here who have a real detailed knowledge of the international markets. There's no one better to talk, and we'll come and introduce those guys in a moment. My name is Matt Richards. I work in a group at JLL which solely focuses on moving capital between the different regions. So spend a lot of time traveling, etc., and working with a number of the different international investors all of you are hearing about today. But to try and ease everyone into the session, first of all, I've been lucky enough to be joined by my colleague David Green Morgan from Singapore, who's going to give a bit of a scene-setting presentation which will set out where this money is coming from. Once we've had that presentation, we're going to look in a bit more detail about who's investing, why are they coming to the US, what are they looking at, and then we're going to wrap up with some sort of like long-term predictions about what we think about this wall of capital coming forward. So David, I'll hand over to you.
Thank you very much, Matt, and good morning to everybody. And as Matt mentioned this morning, just to give a brief scene setter, really, in terms of US inbound capital and why international investors look at the US market. So we'll look at the capital formation in terms of where is this money actually being created, why does it want to come to the US real estate market, and what we think the future will hold for this global movement of capital. Just to give you a sense of how important international capital is to the real estate markets, the numbers we analysed last year, half of all the deals done in the world involved either a foreign buyer or a foreign seller. So the international flows of money have become increasingly important since the financial crisis. And one of the biggest drivers of this capital formation is, of course, demographics and the rise of the Asia-Pacific economies within the wider global economy and the importance that they have taken on in the last 10 to 15 years or so. And now we're starting to see that capital become increasingly more important in global real estate markets as well. As you can see from here, the Asian countries tend to have a very strong savings culture in terms of both investing and saving in real estate in particular, but also now, as these markets are maturing, in more institutional type products like pensions, insurance, and investment funds. And the pension industry globally is obviously facing this demographic issue of a much older global population who are focusing on obviously their retirement. So as more and more of us get older, we're tending to look at more stable, maybe lower returns in return for additional safety. And pension funds have started to address this issue, as you can see here, by a much bigger move into what is commonly termed the alternative sector, which covers a lot of different types of investment that pension funds and institutional funds in particular look at. But you'll see direct real estate is the biggest component of that move into the alternative industry, which we now see going into even more alternative directions in terms of wind farms, infrastructure, student housing, those sorts of areas. But if you look at some of the countries and the size of their capital bases around the world, you'll see that actually the numbers add up to some pretty staggering amounts very, very quickly. And if you assume that this institutional money will divert or allocate between 10 to 15% towards direct real estate, you quickly get up to about $2 trillion that is currently allocated to real estate but is not yet spent within the real estate industry. Now, we all know that globally there isn't actually enough institutional quality real estate to absorb another $2 trillion worth of investment. So this will show in a moment how some of the more sophisticated capital sources are looking to access direct real estate in many, many different ways. Of course, over the last 5 years or so, there's also been the unexpected liquidity surges that we've seen from different parts of the world. The QE that started here in the US has spread to the UK, to Japan, and most recently the European Union. And this surge of liquidity that we're seeing, combined with the regulatory environment that many institutional and financial services companies are facing, is now we're starting to see Europe become a net exporter of capital within real estate. For the last 6 or 7 years, it's all been about capital flowing into Europe. Asian money to begin with, then US money, and now we're starting to see those European institutions look more towards the US to gain some real estate exposure. So why should this money look at the US anyway? It's a very big world. They've got lots of properties they could invest in their own countries. There's lots of opportunity in the real estate market. But fundamentally, the US dominates global real estate. Not only is it one of the most transparent markets in the world, so access to information is very easy. There's a good rule of law. Your ownership, you know, is 100% guaranteed. These things are very, very important when you look, particularly from institutions, when they're investing in real estate. The US is also by far the biggest transactional market in the world. You'll see here our numbers from last year. And actually, if you add up all the 9 other biggest markets in the world, they still only just beat the US in terms of the size of the transactional market. So it's an enormous opportunity for capital from around the world, because they know that not only is this going to be a country where they can build up their portfolios, but it's also a country where they know that there'll be ample liquidity to exit on the way out. It's also the biggest market by value. These numbers come from our colleagues in LaSalle Investment Management, who each year do a summary of the size of the commercial real estate market around the world. And you can see here the map has been distorted by the size of the markets. And you'll see that while it's a very big world, actually in real estate terms, there's only a very few markets that give you that bigger sense of investment opportunity. Also, over the last few years, the US has delivered some of the most consistently strong direct real estate returns in the world. Some of the recovery markets, such as Ireland, has had some exceptional performance. But again, Ireland is a very small market. You're not going to be able to allocate $2 trillion in Ireland, that's for sure. But again, in terms of the most mature markets around the world, the US continues to do very well. But as you'll see, in comparison to property equities, there is a bit of a mismatch there in terms of last year's performance, at least, and that will come on in the panel session in terms of how you access commercial real estate. Do you go the direct route? Do you go indirect? Do you go REITs? Do you go debt? It's a very interesting discussion to have. And so what do we think of the future? We know the US is the biggest market in the world. We know there's all this capital out there. Are the two going to match up together? Well, actually, traditionally, the US has not been a particularly favored market for international capital. It tends to only attract about 10% of all the deals done in the US involve foreign capital, and about 60% of that comes from Canada, which, depending on your view of the Canadians, is either foreign capital or just an extension of domestic capital. But actually, in the first quarter of this year, we've seen a real jump up in that foreign investment, up to over 20% in the first quarter of this year. So the signs are that this big movement of capital is maybe starting to look away from the opportunities in Europe and starting to look more closely at the opportunities here in the US. And just to pick out some of the nationalities that are invested, you'll, I'm sure, recognize many of the deals that these groups have been involved in, but also from a previous slide, you saw how the formation of capital is now starting to translate into much more investment activity from these nationalities all around the world. But their focus remains on the biggest, most liquid cities in the US. You'll see here almost 90% of the activity is targeted in primary markets of the US. So while the international money is focusing more on the US, it's still actually probably disproportionately focused on the biggest markets in the country. And as I touched on previously, in reality, the global real estate market is actually fairly concentrated in terms of the locations. You saw previously when I showed the top 10 countries from 2014, those top 10 countries accounted for over 80% of all transactional volume. And these 30 cities account for 60% of all transactional activity. So as I said, while it's a big world, there's lots of property out there. In terms of investment grade and institutional grade quality, it's actually a fairly limited geography and number of cities. And hence we see investors looking at many more different ways to access the real estate markets in these particular locations. So they're still geographically, they're still very focused on the same places, but how you access the exposure, the real estate exposure in these places is becoming much more complex and sophisticated. And probably one of the biggest new sources of capital that we've witnessed over the last 5 years or so has been the growth in private individuals and ultra high net worth individuals in particular. So in addition to all of this institutional capital, the 2 trillion that I talked about at the beginning, we estimate that by 2020, there's also going to be an additional 200 billion coming from high net worth individuals. Many of these are based in Asia and in the Middle East, who typically have a higher allocation to direct real estate because they've historically invested a lot of money in real estate and they feel very comfortable in owning the asset class. Here you see in the red box that globally about 5% of billionaires' wealth goes into real estate. Probably if you were to look at that from the Middle East and Asia, that would be more like 20 to 25% allocation to real estate. And actually some of the biggest deals in the world over the last few years have been done by very rich billionaire investors. So it's something that we probably didn't see prior to the downturn in the cycle, but something that's really made a very big impression over the last few years or so. But as I said, in terms of global comparisons and the ease of access for international capital, you see the US is actually a long way down the list of countries where international capital moves to. And why is that? Well, one of the biggest issues that we discuss with investors from all around the world is the tax environment. Not that JLL is an expert in tax. We're much better at finding and sourcing the deals for people. But whenever you talk to international capital about the US, the issue of tax and structuring is the first or second question that they ask about. And actually, we don't see it as a complete, a complete barrier to inbound investment. And actually, we think it probably drives more JV activity in the US than we see in other markets around the world. So last year, 32% of foreign investment into the US was through JV opportunities. In other markets like the UK, for instance, we see much more 100% direct ownership because the tax environment is very different and it's much easier for them to come in and acquire the whole building. So with that backdrop, I'll hand back to Matthew to start asking a few questions.
Thank you, David. So just before recap some of the points that David said there before we get into a bit more of a deep dive. So the first thing, which David said, we're seeing an increase in the global saving rates with allocations to real estate. David has commented we're seeing investors from all over the globe, but traditionally the amount of international investments into the US has been relatively small compared to some of the other global markets. Investors have been attracted by the transparency and the risk-adjusted returns, but he also alluded to the fact there are some impediments which maybe block some of that inbound capital into the US. And that's now really what I want to start to have a look at a bit detailed about why they're coming, how they're coming, and what may impact their decisions to invest in the US. Now today, we're lucky enough to be joined by 3 experts in international investment. They probably need little introduction, but I am going to do a very brief introduction for them all. So first of all, we have, sitting in the center, Martin Bruehl. Martin is head of international investment at Union, one of the largest open-end fund providers in Germany, with about $25 billion.
A bit more now.
A bit more, see, more coming in all the time. So Martin's got a real great handle on what specifically German investors, but looking across the whole of the globe and how the US compares. We have Mark Bilsman, who heads the equities side at MetLife, 22 years at MetLife, one of the recognized institutional experts in the field, will give a great perspective from a US domestic investor who's got experience working with international investors. So we'll be asking Mark a lot of questions. And then Tom Arnold, who runs the Americas at ADIA. ADIA is the Abu Dhabi investment fund, basically based for investing the oil reserves of Abu Dhabi. No one quite knows how big they are. I'm not going to ask Tom that because he can't tell me. But let's just say they're massive. And prior to that, Tom had a career at Cerberus, so he's also got experience in the private equity side. So he'll be able to give us a very interesting backdrop of what sovereigns are looking at when they look at the US market. So Mark, if you don't mind, I might come to you first of all and say, in your experience to date, where are you seeing the most interest in the US come from? What parts of the world?
Well, I think David did a nice job, kind of summarizing the overall picture, and I think that it's a very broad, amount of interest across the globe in the U.S. for the reasons, kind of outlined. Certainly, I think from my perspective, there is, however, a significant difference in terms of both level of sophistication, level of capability today, and experience in making transactions happen in the U.S. And starting with the Canadians who've been at it for a long time, who've built staffs who are able to transact directly, to asset manage properties directly, not to operate properties, but to asset manage properties directly, and groups like Tom's ADIA, who's built up a significant organization with teams with expertise in the different product types, and again, direct investment capability, and certainly a number of the major European investors, including the Germans, have that kind of capability. I think a lot of focus today is on Asia, and in particular China, which has been a country that has had dramatic growth and dramatic wealth creation, and now more than ever before, for both regulatory reasons as well as investment diversification reasons. We looked at sort of the size of the Chinese market compared to the U.S. market. They're very interested in expanding overseas, and yet I would put, on balance, Chinese investors as still in the mode of figuring it out and needing a significant, I would say, amount of help in terms of developing strategies to access real estate.
That's perfect. Let's pick on that point for one moment. David, I'm based in Singapore, but it's your second home in China, the amount of time you spend there. Quite often we characterize Chinese investors as just simply Chinese investors, but I know there's far more than that. Can you just give us a brief review of what you're seeing as the different types of investors and what are their drivers from China today?
Yeah, well, it is true that I guess we're as guilty of anybody is of categorizing people into nationalities rather than necessarily investor types. But there's very many drivers in terms of the movement of capital out of China. Part of it, as Mark said, is regulatory. The movement of capital out of China is now far easier than it was 10 years ago. There's also been a government push to move capital and to internationalize the Chinese companies. And also, of course, the Chinese economy is going through an evolution in terms of moving from a very strong investment base to an ever-growing consumption base. So all of these dynamics are at work in a very complex country. But I guess we probably see about 5 different types of Chinese capital. You've got the sovereign funds, you've got the insurance companies who have actually only recently, back in 2013, actually been allowed to invest in real estate even in China, never mind investing in real estate around the world. So they are very, very new investors, but their capital base is enormous. You see some private equity funds, although those tend to be much smaller than you see in other parts of the world, but still very active. Obviously, you've got the high net worth individuals that we touched on, some enormous private investment and private capital in China, which is starting to find its way into real estate markets around the world. And then the ones that probably grab the most headlines are the residential developers who have been buying up tracts of land in the biggest cities all over the world: LA, Toronto, New York, Sydney, London. And typically they are building the biggest residential towers that these cities have ever seen. 2 of the biggest towers ever to go up in London will be Chinese residential developers. The biggest tower in Sydney will be a Chinese residential developer. The same in Toronto. They're involved in very large multifamily and condominium schemes in LA, San Francisco, New York. And understandably, the press gravitate towards these stories, but from the discussions that we have, and we've been intimately involved with many of these groups, they see it as a very simple extension of their business model. They are expert residential developers, and they are now exporting this knowledge into other markets around the world. And hence, they see it as a very natural extension of what companies from all over the world do, and hence that's why they're doing it.
Great. You picked on one point there, which I'm going to jump to Tom on, which was around, you said sovereigns, in plural, for China. And I think that's one of the big things that we've seen, and I've seen recently, is the growth of the amount of sovereign funds looking at real estate. Now, ADIA was one of the leaders and one of the initiators in that area. What experience have you seen of other groups similar to ADIA making the decision to try and get into direct real estate, Tom?
Well, I think there's a significant trend. We see it in terms of, I mean, there's the Sovereign Wealth Fund Institute is a big organization, and now I think it has, I'm going to just take a guess at this, 70 members or something like that to get together and talk about their investment strategies. That's not just limited to real estate, but it includes real estate. And one of the places that I look for cues is through the talent market. And I know I've been contacted by a number of sovereigns that are taking a very passive, old style of investment and wanting to be much more active. And so there are a number of sovereigns that are in the process of building out staffs and changing it from 3 people that cover real estate from the world to trying to build staff. I think at our organization, I think our headcount in real estate now is between 175 and 180. So it's a big team that covers the world, that covers 20 plus countries. But I think that as the sovereign challenge is the same as a challenge for any other investor. That's yield and return, and sovereigns historically have bought a lot of each other's credit, and that generates almost no return as you look around that type of fixed income investment. So for some sovereigns to take approach as more of a fixed income alternative and getting a 5% yield on a quality piece of property before leverage, it looks pretty attractive relative to a percent on a country's general sovereign credit, and the equity strategies as well are expanding, and we see it from again, I get a lot of calls from recruiters for not calling me necessarily to try to move me, but for reference checks on people, and there are a lot of sovereigns that are very active, and the Chinese are becoming very involved. Many of the Chinese organizations that David referred to are either have committed to or are discussing opening New York offices. Yeah. And my observation generally, just because I'll always tell you what I think, is a lot of cases it looks like they were trying to buy Rolodexes to me. They were trying to hire, in many cases, people that know a lot of people, have been in brokerage industries, but have never invested. So it's a curious hire. If somebody's well connected, but not particularly deep at real estate investment, they're still getting contacted by some of these Chinese organizations. So I really wonder what the role and how substantive that role will be over time, or whether they're buying Rolodexes, but we'll see.
And I guess one of the...
Am I so old that people know what a Rolodex is? There was a lady, I'm going to digress just for a second. There was a lady in the plane next to me, and she was talking to this guy. She was telling she was with her son, and they were lost, and they needed directions, and she pulled up to a car, and she made some gesture, and the guy rolled the window down, and she asked for directions, and her son turned and said, "How did you get him to do that?" And she said, "I went like this." And he said, "Well, what is that?" She said, "In the old days, you used to crank the windows down, you know, so." So Rolodex, I'm really dating myself, so. Sorry.
That was good. So just before I let you off the hook totally, though, would you say, because one of the key things which David's assumptions and around the flows of capital, one of the key drivers behind that is the emergence of sovereigns entering the real estate market and that continued build up of cash, whether it's MPS, who only really entered in 2010 and now put in a lot more money in, just to pick one. Do you see that as a trend that's going to continue, or is that just something that's happened at the moment because of low interest rates, or do you think this is a structural thing that's here for a time to come from the sovereigns?
I think it's a trend that will continue. I mean, real estate, and particularly direct real estate business, is an active business. It can be a very difficult business, and I think the people that want to, I was a GP for many more years than I've been an investor, and you know, my cynical view of investors oftentimes is their eyes were bigger than their stomach. They always wanted co-investment rights, and they wanted these things, but they had no staff and no really ability to execute it. And I think there's finally a realization of that. And I think a lot of the organizations are beginning to commit to the people and becoming, have a much greater ability to implement, as opposed to just to passively invest. And most of the investments for sovereigns historically was with funds that were just allocators at the end of the day, not vertically integrated companies, but just managers who then picked, other operators and managers. And so I think that trend is changing. There's also, I hate a typo, and just because you had it on an AFIRE slide, you had the AFIRE, and I'm the current chairman of AFIRE. It's FERPed with a P, not with a B.
So the P stands for property. Yes.
Sorry.
You thought it was buildings. It's fine.
I had to say that.
But yeah, it's, particularly because it was on our slide. But and we do know the difference. But sovereigns actually, if they will use sovereign status in 892, there's a tax provision that in a passive role, sovereigns have a very tax-advantaged way to invest. And so, not that it's going to be completely driven by that, but foreign investors are generally treated very difficult relative to many countries around the world. But sovereigns, with the big proviso that they can't have much control. So the general tax theory, and if there are experts in the room, I apologize, I'm just going to kind of dumb this down, but the U.S. welcomes the allocation of capital to the U.S. as long as you don't want any say. So, you can, a foreign, because it makes capital more plentiful, it makes the capital cheaper, and that presumably is quite good for productivity. So you can own less than 5% of a public company, and those dividends and those returns are tax-free, and there are certain provisions. But when you step in and you actually want to have say and control and involvement, then it's looked at differently. So there is an ability for foreign sovereign status, and that's not limited to a country. We talked about, there are multiple sovereigns in China, there are multiple sovereigns in the United Arab Emirates. Yep. So it is organizations sufficiently associated with a national government and sovereign that the U.S. allows this special
if they choose to use it. One of the things I find quite interesting in my role, based in London but traveling a lot, is a lot of my European colleagues say, can you introduce us to Chinese money? Can you introduce us to money from the Middle East, et cetera, et cetera? And one of the facts that I constantly remind them of is actually over the last 10 years, the biggest investor on the global scale has been the Germans. The last 10 years, they've invested $150 billion in international real estate. So when we look at someone who's a mature international investor, I think there is no greater example than the Germans. And to that very point, I'm going to hand over to who's better than Martin, who runs the whole of the International Investment Fee Union, to give us a bit of overview of why the Germans have been looking outside of Germany for such a long period of time, so what they look for from international real estate, and then also maybe give a bit of an insight when you look at the world, how America fits into it.
Yeah, okay, well, everything that I've heard so far from my three fellow panelists indicates that this will not be the case in the next 10 years. The Germans will be the biggest exporters of capital. So I'm quite saddened, but it doesn't come as a surprise. But looking back 10 years, why was this the case? I think there's three reasons. First of all, you got to be pretty productive economy, and you have to create quite a lot of wealth to be such a big exporter with 82 million inhabitants. And what the Germans differentiate from the Americans, for example, and the Irish and the Spanish over the years was, I didn't mention the Greek, did I? Was we had a positive savings rate. So we didn't consume it all what we produced, we actually saved, and therefore there was enough wealth around to actually export. The second reason is over the years, the Germans became more sophisticated and more courageous to overcome the home bias, which I think is quite natural. The grass isn't always greener on the other side. If you're investing, you may find that if you go to Australia or to the US, you have a disadvantage in terms of transparency, in terms of access to information. You know, there was at some point the belief in the world that there's stupid German money which is being exported because we tended to pay high prices, but then if you don't pay the highest price, you don't get the deal normally. So if you want to invest, you have to do that at times. So there's increasing sophistication which actually helped us to overcome that home bias. And I think the third reason really is our investment universe over the last 10 years, again looking back, but I think this actually applies also to the next few years, was shrinking. It was shrinking for the sheer reasons of the euro crisis and the problems we had at the periphery of the European Union and the Eurozone, which led us to, stop even think about Spain, Portugal for a while, and where does the money go, which is still being produced and saved. Countries like France and the UK had their particular issues because they're centralized models where there's one capital and the kind of in France, Paris and the Ile-de-France around it, which attract 80% of the investments in that country. We're quite highly exposed to Paris already. In the UK, a very centralized market with London and the southeast. Pricing in London, everybody who tries to invest there, Tom, people, it's prohibitive at times, and we are big sellers as well, although we have just acquired a joint venture there as well, so you have to kind of find the deal and identify them, but effectively London is getting so expensive. And then, of course, the home bias meant that over the years, the Germans have actually accumulated quite a lot of wealth in Germany. And coming back to my point of sophistication, everybody has read Harry Markowitz and modern portfolio theory and don't put all your eggs in one basket. So diversification and the ability to actually benefit from different cycles and then time the cycles and enter and exit a market and then make super profits was something which attracted the Germans as well. I think this is going to continue for a while, but will be overtaken both in our productivity as a national economy, still the powerhouse of Europe, but will be overtaken by the East. That shift of economic power from the West to the East will also make us lose out there.
Okay, and today, and it might be something we can come on to with Tom and Mark as well, how do you see the current shift that, relatively, the euro has collapsed 25% against the dollar? Does that change your view of investing in the US? Does the US suddenly become prohibitively expensive for you versus some European countries? How do you deal with the currency side of things at Union?
Well, first of all, we are, in Europe, we're equity investors. We just go in for cash. And we currently have the good problem to sit on 4 billion euros of cash, which is no longer king. It's actually quite a burden if you don't get an interest rate or if you get negative interest rates. So to have cash drags you down in terms of your fund performance. So I think what is king now is having access to cash and call it when you want it, when you have a deal. But to have it sitting on a bank means we have to be very disciplined. We actually closed down, in terms of sale of units, 2 of our flagship vehicles, 2 funds, 10 billion euros heavy each. We had to close them down. We didn't sell any units because we couldn't find the product fast enough not to have more cash dragging down performance. So having said this, outside the Eurozone, our approach to currency is we do hedge our foreign currency positions because our funds are euro denominated. So we also by law have very moderate leverage. We go in 40%, 45%, maximum 50% of debt. So we have debt in local currency as a natural hedge. And the rest we do have to hedge. And therefore that adds another cost, another obstacle for us to go outside of Germany, which is a fact. In Australia, if you hedge 50% of your investment, it takes off almost like 3% of your return. Because it's so expensive.
Yeah.
In other countries, you actually make a hedging gain. In Japan, you actually earn a percent, which is funny. So to answer your question, it doesn't prevent us from going out. It just makes deals more complicated, and it adds the hedging of currency into the equation.
Okay. And Mark, in your dealings with, say for example, you've got the JV, well, the arrangement with Norge and investing a lot with Norge. How do you see currency in that involvement at all?
You know, I think from in that perspective, they're a very, very long-term investor, and I think they view kind of a dollar cost averaging process over a very long period of time. It's almost the same as you know, their view that if we saw yield expansion here and values decline, they would not be worried about the deals that they did because they're planning on holding them for the next 50 years and they're going to recover, and they would actually view that as a buying opportunity, and they would be excited if they saw yields you know, expand. So I think with, you know, some of the other folks we have spoken to, I think there is at the margin probably an interest in doing a little more leverage to sort of naturally hedge that part of the capital stack, but I'm not seeing a major negative factor at this point.
Okay, great. David, turning to you, one of the things which people, well, I definitely read in the press is that people say that money's coming from China because there's a concern about a bubble and it's all going to blow up, and that'll have ripple effects across the whole of Asia, and therefore people are trying to get their money out. And when you do that, you look at the US, and the US looks safer than anywhere else. What's your take on that, living in the region?
I think the bubble risks in the residential market have greatly subdued compared to probably 2 years ago, not just in China, but also in Southeast Asia and in Hong Kong. I guess one of the advantages those economies have, because they're more centrally planned, is they can bring in regulations very, very quickly. So in Singapore, for instance, we've had 9 rounds of what they called cooling measures, the most effective of which has limited the amount of money that you can actually borrow, and they've increased stamp duty to 20% for foreign buyers to try and, because that's where they felt the market was overheating. So I wouldn't say that the movement of capital from China at the moment is flight capital. I wouldn't say it's worried about the Chinese economy. I think it's just that over the last 30 years, so much capital has built up in China, and now it's much easier for them to export it, that they're taking advantage of being able to do that. So I would say it's more of a positive movement of capital than a negative movement of capital. The Chinese economy is obviously changing every year, but I wouldn't say it's still going to be probably one of the best performing economies in the world this year and probably for the next few years going. So I don't see it as a concern at the moment. And I suspect why we see so many residential developers coming out of China is that there are many reports that have been written that are saying that China is probably at peak housing. So actually it's probably got enough overall housing. Whether it's got the right quality in the right places is another discussion, but actually in terms of the overall amount of housing that it needs for its population, given the declining demographics, then the only way for these companies to grow, and don't forget most of them are listed companies, is to go outside of China to seek opportunities.
Okay. We touched upon it, and Tom quite rightly picked up the spelling error. Thanks for that, Tom. But obviously there are impediments and challenges for any international investor entering a market, and the comments I quite often receive, especially when an international investor wants to look at somewhere like New York, you have tax, but you also have speed, and how do you get access to the product, and how do you work within that marketplace? Mark, when you're speaking with investors and you're coming in, how do you sell the fact that it's best to have a local partner to work with?
Well, I think that you know, there's several dimensions, and certainly the tax dimension is an important one. If you're able to set up a tax-efficient structure along the lines that Tom described, the savings can be significant. So if you are subject to FIRPTA, you're paying basically the highest ordinary income rate on your capital gain. You have to withhold taxes at the time you transact, so the capital gains are roughly double what they would be for a U.S. investor. And there's also significant tax withholdings on income distributions. So with the type of structure that Tom described, you can achieve no withholding on income distributions, and if you achieve a sale in a proper way, you have normal capital gains tax. You don't have, in essence, this double factor. So it is a very important thing, and there are various structures to do this, but one of the simplest structures is to have a domestic partner that is controlling the transaction with 51% of the capital. And so that, obviously, if you're an institution or you're a money manager that has access to domestic capital that you can pair with a foreign investor, clearly that's an advantage. I think again, depending on the level of sophistication, people that are initially investing in the U.S. tend to be very risk averse, and they appreciate having an experienced U.S. partner with skin in the game aligned with them. If they're a more experienced investor, they tend to really gravitate to sort of the best-in-class operators and look for opportunities to invest on a more direct basis with operators. I do think you mentioned the kind of speed and decision processes. That's clearly an important factor, and sometimes you see big prices being paid, and I think they're being paid for a couple of reasons. One is because folks have very long-term horizons, and they're not typical value investors like you would see oftentimes in the U.S. So they care about what they're buying and where it's located, and they have, again, if they have a 50-year time horizon, the access point or the access price is not as important as what the property is and where it's located. But you certainly have certain organizations that are not set up to make decisions in a day or decisions in a week. They may have monthly investment committee meetings with substantial processes before you even get to the investment committee. So in order for them to be able to access property, sometimes they offer prices that make it provide an incentive for the seller to give them the time they need to work through the transaction. And if it goes, it's a big win for the seller. But I think in a number of cases, some of the smarter global investors who are just beginning to access the market are willing to give discretion to a local investor who has skin in the game and who has an appropriate incentive to do the right thing. And then that local representative, in effect, can act in a commercially viable kind of manner here. So I think the tax issue and the process issue are probably the two biggest.
And I guess picking on that, coming to Tom, because I must admit, we see those stats and produced with RCA and JLL, but sometimes I question them myself, because there was an article by Fox Business which said, we record 10% or 21% this year, but quite often you don't actually know the capital that's sitting behind, say, the US domestic investor who's buying it. So there's probably a lot more foreign capital that's actually coming into that marketplace. Tom, you have a big team, as you said, of experts who look at real estate, and yet, perhaps incorrectly, and I won't ask you to talk too much about ADIA, but I've seen you as someone who's partnered with people or gone with managers, etc. But you have a big team and a team of experts as well. Can you talk a bit more about your thoughts on that matter?
Sure. I mean, picking up on Mark's point a little bit, I agree with everything he said. But if you just think about, risk as being kind of an outcome uncertainty, and you really can't know too much. You really want to have as much local knowledge and as much nuanced knowledge as possible. I mean, if you're sitting somewhere else in the world, I mean, how do you know that the exact same building trades differently on the east side of Madison Avenue than the west side of Madison Avenue? I mean, there are little subtleties like that that really require, experience and time in the market. So we certainly have a bias to invest with knowledgeable local partners. And then even within our own organization, one of the reasons that we've grown as we have is that we, we decided that, we didn't want to have Asians investing in Asia. We wanted to have Chinese investing in China, and Indians investing in India, and Australians investing in Australian, and so on. So we have now, I think, about 35 nationalities in our team. So in almost all instances, whatever market that we're looking at, there's at least one or two experienced investment professionals that are native, that that went to, were born there, that went to college there, at least their undergraduate, and trained in that market. And we found that the ability to choose to select our local partners and make these more nuanced decisions has become much better when you really have those cultural sensitivities, in each market. So, if you're making an investment choice, do you want to know a lot or do you want to know a little bit? I mean, by definition, the more you can know, and the more granular you can become in your analysis, oftentimes that can be helpful. It can also be a curse sometimes, in the sense that you can fall into kind of the analysis paralysis, and you sometimes have to kind of step back and say, does the basic investment premise make sense, and what do I have conviction about? And and I think your organization does that quite well, Martin, in the sense of we sold an asset to Martin a couple years ago. I'm sure you've done very well with it, and you guys made a very strong decision about a market that you thought it was a market where you wanted to be invested, and I think it's proven to be very true. It was an asset for us, and we didn't view it as long a term hold, and we had other things we wanted to reallocate to. So I think we were happy with the sale, but I think you've probably done better with the asset than we did, which was,
You can't have it all. You can't have the cake and eat it.
And Martin, I think that moves on perfectly, because we're here in Houston, and you've recently closed on a trophy building in Houston. You tend to be much more of a direct investor, working with local experts within the marketplace. You've moved Thomas over here to be based in New York, to have boots on the ground. How do you approach investing in the US? And maybe talk us through some of your experiences on 1000 Main.
Yeah, I'm happy to do that to the extent I can share this. But I mean, you're absolutely right. You have to have the local people to actually do that. There's so many cultural barriers. I mean, we've just recently also acquired a building in Japan, in Tokyo. That was quite difficult, but we've got Asian team members, not Japanese as yet. In the US, we have been working very closely with a company called Metzler, so we've got our local boots on the ground.
Don's there in the crowd.
That's why I did the commercial. Although we have a growing team also now in New York, as you mentioned. But 1000 Main, just up the road really from the Hilton here, yes, we had a few issues which we had to get comfortable with during that transaction. And this is the energy capital of the world after all, and something happened to oil prices recently, as you may have gathered. So we had to get around that issue. But we actually, with our advisors, we learned a lot about the oil industry. And the oil industry, oil and gas, isn't just oil and gas. There's upstream, there's midstream, there's downstream. You have to analyze your tenants in terms of how exposed they are to that kind of situation, because some people in the midstream business, the pipeline business, what have you, they actually benefit from higher demand as much as the downstreamers do. The petrochemicals, they've got a cheaper commodity coming in. So you have to differentiate, and we did that very carefully. 1000 Main for us is a long-term investment, and we think that the short-term dislocation of prices and the commodity side will outgrow and will, within the next, call it 18, 24 months, and we've already seen some improvement there, actually remove that worry for at least the shale gas producers, what have you. Other issues were falling demand in the short term, yes, but then you have to do your underwriting prudently, and you allow for lower rents and less growth, and that's what we've done. Falling values, yes, because we've seen this in Houston in the 80s. It was a disaster, but I think the Houston economy is now far more diversified, so we've got comfortable with that kind of mix of the economic sort of base here, although it is still the energy capital of the world. But we adjusted the price after the initial buyer backed out, that's what you had to do. So we were comfortable with that value element, and finally the supply shock potential here. And we analyzed, of course, also the pipeline there. And 80% of all spec development really is going to happen outside the CBD of Houston. And then if you drill down to Houston, effectively all the proposed schemes were put on hold. That's at least our intelligence.
Except for one.
Right. Except for one. Yeah, 609 Main, Heinz, they will continue, but they will only deliver in 2017, and they have to ask higher rents. than we as an existing builder can actually offer. So we're going to be very competitive, and we've got 7.1-year WALE. So I think we've done our homework, and with our advisors got comfortable and had our investment committee not every month, we have it actually every fortnight, and can do a special one if need be as well, which we did, so we can act and transact quickly.
Before I move into sort of like what investors are looking at today, putting you all, because what I think is quite interesting is we've just been going through why the US, and I haven't heard any specific things saying we are looking at the US over Asia or over Europe for this specific reason at the moment. It seems like there's much more of a, we're investing in the US because it's part of a diversification strategy to have exposure to different markets. But if I put you on the question, I'll ask each one of you, and whoever goes first is probably going to get the immediate question. What would you say, let's start with Tom on the end, what would you say is the biggest selling factor when you sit there in your investment advisory committee and you're looking at different things? What's the biggest sell for the US market today?
Well, I think to start with, I might point out that its demographics are the best of any developed country in the world. And sometimes demographics are hard to ignore. So as you look at the aging developed countries, the US is much better situated than many of those. And the productivity growth has been, although flattened a little bit, I think there have been, it's been a great story. We've done a lot of investment in the Bay Area and Silicon Valley, and the job growth and the idea generation and the company growth. And my only real regret is the U.S. has got to get their immigration policy figured out, because I think we're training some of the best and brightest minds in the world, and they complete their masters or their PhDs in MIT or whatever, and then we say, okay, you've got a really short period of time, then you need to get out. And so they're kind of surprised, and they're off to Vancouver or London or a number of places. And why we're exporting that talent that would love to stay here, love to be here, I don't know, and I hope the politicians get this right soon. But I mean, it's a great story, and we hear about all the growth stories in the pricing opportunities in Europe and the growth opportunities in Asia. But I can tell you that the returns in the Americas have outperformed Europe and Asia for 6 consecutive years in my organization. So.
You definitely took more than one, so that's probably a bit unfair for the rest to come across. But Martin, when you look at the US?
There's not much left now.
No.
I mean, our capital source is core, so we need to have a safe haven,
yep.
And we need to have transparency, the absence of corruption, all the good things which we will find in the US. And our philosophy is very simple. In the short term, follow the jobs, and in the long term, follow demographics, and that speaks for the US.
So moving on, I won't ask you to find a different one, Mark, but moving on from that, one of the things that Martin just touched on there, Mark, was about the fact that they're core investors. And traditionally, the slides which David put out, we've seen that largely, if we put to one side the Chinese influx looking at development in the residential sector and the multifamily, we've seen international investment focus on core. Have you begun to see that change, or have you begun to see that change from an international investors looking at maybe taking on more risk or moving to secondary cities?
From my perspective, it's kind of a natural progression with getting sophistication, with getting familiar with the market. So when someone first comes, and many of these folks are core investors because they're investing for underlying liabilities that are very, very long liabilities. So core is sort of the natural place for them to go. But invariably, it seems that the first thing that what they like to do is to buy an office building in Manhattan. And then they expand to San Francisco and Washington, D.C., and maybe Boston. And then as they get more, over time, over years, as they get more familiar with the markets, they get to know more people, and they start to see value opportunities in other cities, they gradually expand to those other cities. But I think it does depend on the model and the investment objectives. There are certainly some global investors who, in the core space, they look at things very differently than we do here in the U.S. And if they're interested in a globally diversified portfolio of core, they may say, I want to be invested in no more than 10 or 15 cities around the world. And by the way, in the U.S., there may be 3 cities that comprise that scheme, and then they get a lot of knowledge and capability in those 15 markets. So I think again, it kind of depends on the investment strategy, investment model, and then I think there's a factor in terms of familiarity and willing to look for value. But again, if these guys have, I mentioned it a little bit earlier, but it's a very important point that if you have a 30, 40, 50-year horizon, what you buy, and this is actually backed by research, what you buy and where it is much more important than your entry point. If you're doing a 5-year value add strategy, it's all about the price.
Yep.
But if you have this long-term horizon, it doesn't matter as much.
And Tom, in the period that you've been investing Fadia in the US, what you started buying to where you are today, has there been an evolution? Have you built up your teams? Have you been willing to take on more risk, or is it still the same type of things you were looking at today as you were looking at when you first entered the market?
Well, I think risk is different in different hands, and so I think that if somebody were sitting on the sidelines and looked at the migration of the portfolio, they might well decide that they see greater risk in some of the assets. But we're doing more development, but they're premises that we feel very strongly about, and we build out a development team, so we have people with construction and development and permitting backgrounds and stuff that are part of our team. So when we're partnering with a U.S.-based, or I shouldn't say U.S.-based, but a developer really anywhere around the world, we're pairing them with our own experts, people that have built skyscrapers and big mixed-use projects and those type of things. So we think that that's risk that we can understand. I can't, knock on wood, I can't remember the last time we've had something over budget or wasn't on time. So, if you're delivering, we weren't doing a lot of development 4 years ago because you could buy assets at significant discounts to replacement costs. As asset pricing has approached replacement costs, and you can have a big debate about that relationship depending on how you value land, and land can be so unique that that's a research project into itself. But the idea of kind of how we think about risk, how we manage risk, I think has changed. And we've made a decision in many cases, we'd rather have the new product than the old product. It's like going to the car dealer and they say, we've got a used car, it's only 3 years old, or we have a brand new car and today they happen to be the same price, which one do you buy? So, the value proposition of a lot of assets, unless you've got a irreplaceable location, in many cases we'd rather buy something, even raise it and rebuild it and build for the next 20 years. We're seeing a lot of, I guess, my perception is there's some obsolescence. I can tell you when I bring people to New York City from other places in the world and I show them around to the best office stock in New York City, they go, this is one of the great cities of the world and this is what goes for Class A office. They can't believe it. And, there's been a half dozen projects, that have delivered in the last 15 years, but, most of the bones of the best product in the city
60s
is 60s vintage. That's pretty extraordinary.
Yeah.
So I think there will be some real some opportunity, and we're seeing some big bets being made now in Manhattan on the development front.
So Martin, pose a bit of a question before and a bit of background. So we've seen, I guess, on a global basis, the emergence of Korean capital, been very active. We've been predicting it for a while in your own home market in Germany, where they're coming in, they're chasing yield, and it's that magical net cash on cash of 6% which they chase. And we've seen them active in the US on the same sort of basis, coming in chasing yield, which has probably taken them to the markets which traditionally an international investor may have looked at as being more secondary. But then more recently, Martin, you've made an investment into, I like Houston, but I love Austin. So Martin's just bought in Austin, one of my favorite cities in the world. When you look at someone like Austin, is that going back, your investment decision there, is that looking for an edge on yield, but also applying your around population growth from the story of the location?
I mean, the only reason we acquired that building in Austin, Texas was because Austin is the world capital of live music.
That's the reason I like it.
So that's
street. That's right.
End of story. No, joking apart. It's got all the ingredients of growth, of a diversified economy. There's government, there's medical, there's high tech and everything. So and the asset was perfect. So that was a logical choice, but actually a choice in implementing our secondary city strategies. So for once, we actually designed a strategy of going into secondary cities, and then we actually did the deal. Didn't do it the other way around. And we can prove this because a few months later we acquired a building in Minneapolis, which I think is also a great story in terms of its economic base, but it's not where I think the Koreans would go immediately, would they? So, but this secondary city is only one part of our strategy. We also do forward funding. You mentioned this, Tom, I think, which differentiates us from a few capital sources, at least from Germany. And we go into joint ventures. We are prepared not to own 100%, as recently demonstrated with the JV with Oxford Properties in London. But the secondary cities is also something we've applied in Australia. We didn't enter in Sydney or Melbourne. We bought and forward funded a scheme in Brisbane. We've bought in Birmingham in the UK, so we are doing this and applying this. This is not rocket science, but this is the way you have to react if you want to still have decent risk-adjusted returns.
Brilliant. So what I'm doing now, conscious of time, because Tom's a popular man, he's got to go and speak on another session. So just before we let Tom go, I just wanted to open the audience, the floor to questions, most notably focused at Tom before he has to shoot off, just trying to manage his time for him. Are there any questions from the audience? Mary.
I don't want to trump anyone, but if there are no other questions, I'll ask. So the U.S. offers 8 property types. I understand that core investors might not define it as fully 8, but to what extent do you use the U.S. as a way of accessing medical office or self-storage or senior housing or student housing, alternative property?
Tom?
You know, I think that the challenge there, I think there are great opportunities and there's niche operators, so there's some very interesting things to do in that space. The challenge for an organization like us is one of scale. It's small enough, and can you aggregate enough of it that it shows up? And we haven't done any of the non-major food groups until we just started what I consider to be a very small program, a couple of $100 million in student housing. And one of the operators came up to me last night late and said, "You guys are, coming into the industry in such a huge way," and I'm like, "This is actually a pretty small, I feel like we're putting our toe in the water." And he said, "A couple $100 million, and our space is gigantic. You're gonna affect pricing, and so there are not many sectors. You wouldn't in an office or a multifamily strategy, a couple $100 million of equity wouldn't be moving any needle, but it does in some of these smaller sectors. So it's just really a scale question for us."
Any more? While we wait for, yes, please. Martin.
Well, we just managed to structure accordingly. I mean, that's really it's a pain, as you pointed out, Tom, but it's quite doable.
About kind of governance versus tax efficiency, and there's a real trade-off. So if it's something that we don't expect to need to make a lot of difficult decisions, we might form that in a tax-efficient structure where we have very little input. And then if it's something where it's going to be a major renovation or repurposing of something, we'll bite the bullet, we'll pay the extra taxes, and we'll make sure that we have control. So it's kind of trying to anticipate before the fact how active we're going to need to be with the property over time.
And I just add that there are, you kind of alluded to it, but there are other tax strategies that can mitigate some of this exposure, though it may not do it as efficiently as just investing 49%. But it's not kind of an all or none situation. There are other strategies to mitigate the tax bite.
Please.
What are the factors that govern the ranking in transparency by country? And one of the slides, the U.S. was number 2. And what is keeping the U.S. from being number 1?
Well, there's about 60 or 70 different factors that we take into account in the transparency index. Actually, that one was launched last year. The previous one from 2012, the US was number 1. And typically, the US, Australia, and the UK fluctuate, sort of almost take it in turns to be the most transparent market in the world. But it's a whole range of different factors, both in terms of property information as well as economic information. So I don't know all 70 off the top of my head, but if you go to our website, you can actually weight the different factors to determine what's most important to you, and then you can see how the different countries will rank. Of the most developed markets, Japan is the one that stands out as having the lowest transparency in terms of the most developed markets in the world.
Please. Do you know what? I'm going to take that one.
Call JLL.
It's, well, not even saying JLL, it is really challenging. I mean, incredibly challenging. We're beginning to work with a group who, as a house, until probably 3 months ago, hadn't done anything. And now they've got 7 million square foot they're developing in Shanghai. So they've emerged from nowhere. And then you look at them and you then have to try and analyze the people who are sitting behind them to understand whether they've got longevity and whether they're a real capital source to come forward. There isn't an easy answer. I think it comes back to the same thing, really what these gentlemen have said here. The only way you can really do something is have boots on the ground. And it really does require hard work in China. And I would say, you know, whether it's JLL, CBRE, whoever it is, but working with one of the big groups out there and just taking the opinions of those. I would also point you to probably working a bit with the different US embassies. It's quite interesting. You'll probably find that some of the different government bodies will know those individuals. From a perspective of, from a perspective of London, I know that we've got one specific group that spends its whole time on behalf of a government basis trying to work and understand who these groups are. I know that the US have exactly the same type of structure to assess and validate some of these investors behind it. So it's work with one of the big players, and that really is CBRE, JLL, DTZ, probably in China, and get some soundings, and then probably work with the local government